Welcome back to Talk Nerdy to Me, a financial guide for entrepreneurs. I'm Michelle Delker, founder and CEO of the Stanley CFO Group. In our last episode, we introduced you to the podcast and shared some of the top financial challenges that small to mid-sized businesses and high-growth companies face. Today, we're going to walk through a financial diagnostic together.
A financial diagnostic? What's that?
Oh, hello, Robin Keithley, Vice President of Operations. How are you today?
I'm good. How are you?
Wonderful. A financial diagnostic. I'm so glad you asked. It's a thorough evaluation of a company's financial health. It analyzes the key financial statements, so the income statement, the balance sheet, and the statement of cash flows.
Oh my.
Yes, to identify strengths and weaknesses and areas for improvement. This allows us to examine revenues and expenses, assess assets and liabilities, evaluate cash flows, and calculate key financial metrics. The goal is to provide a clear picture of the company's financial position, uncover root causes of financial challenges, and offer actionable recommendations to enhance financial performance and support sustainable growth. Before we get into the diagnostic process, it's important to understand the basic financial statements, the ones that form the foundation of any financial analysis. And they're the income statement, the balance sheet, and the statement of cash flows. Let's start with a brief overview of each.
We all know this one, the income statement, the P&L, the statement of earnings. Do you know what the income statement is? It's the most well-known. Everybody knows what it is. It provides a summary of a company's revenue, expenses, and profits or losses over a specific period. It shows how much money the company made, how much it spent, and the resulting net income or loss. We have key components to this. We have the revenue, top line, total income from the sales of goods or services.
Ooh, the revenue. That's what everyone's excited about.
Yes.
Okay.
And then we have the cost of goods sold, basically the expenses that attribute to the production of the goods sold by that company.
So you're selling widgets. It's the cost to create the widget.
Yes.
Okay.
And if you take the cost of goods sold from the revenue, you're going to get your gross profit. Below that, you have your operating expenses. It's the costs required to run the business, such as salaries, rent, utilities. You take that from the gross profit, you're going to get your operating income. And then the bottom line, net income. The final profit after all expenses, including taxes and interest, have been deducted from the total revenue.
My gosh. So it's the fully loaded number then. I mean, the jot and tittle, the net.
Yes.
Oof, goodness. I like it a lot. So it sounds like it's an incredibly important financial statement, but to me, I don't think it tells the full story. It's showing the revenue and expenses that are generated for a finite period of time, like for a month or a quarter or a year. So it's like a report card for your 9 weeks in high school, or maybe even a semester, but that's not the full story, is it?
No, that's just for a short period of time.
Okay. So that's why I really love this next financial statement. And it doesn't get the love that it deserves from everyone, which is crazy because it's the foundational tool for evaluating the overall health and long-term viability of a business. If the income statement is your semester-long report card, the balance sheet is your cumulative GPA for your entire high school career. It's going on your transcript, baby. So the balance sheet provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets, its liabilities, and its shareholders' equity. And spoiler alert, do you know why it's called the balance sheet?
Does it balance?
It balances. Yes, it really does. So key components of the balance sheet are the assets, the resources that are owned by the company, the cash, the accounts receivable, the inventory, any fixed assets like buildings and properties. It also shows the liabilities, and that contains the obligations that the company owes to others. So what could be in there? Like accounts payable, accrued payroll, lines of credit if you have a working capital line of credit. And then equity, the residual interest in the assets of the company after deducting liabilities, also known as shareholders' equity. So there's a little equation. It's super simple public math. Assets equals liabilities plus equity.
Love it.
Crazy. It's an incredibly important part of the equation. And again, it doesn't get nearly enough visibility. It is truly the foundational tool for evaluating the overall health and long-term viability of the business. Goodness me, knowledge bombs. So this next one can be a bit confusing to some, but it's an instrument that walks you from the net income or loss that Robin talked through on the P&L to the cash in bank that I talked through on the balance sheet.
It's the statement of cash flows. The statement of cash flows shows how changes in the balance sheet and income statement affect cash and the cash equivalents. It breaks down cash flows into 3 categories: operating, investing, and financing activities. Your operating activities are your cash flows from your primary business operations. Your investing activities are your cash flows from purchasing or selling assets. I think of the capital expenditures. Financing activities are your cash flows from transactions with the company's owner and creditors.
I love it. And I love how you said, from investing, think of capital expenditures. And so if we look at what we're displaying right now, we can see that in 2021, for example, we earned $2.4 million of net income. We started the year with a cash balance of $312,000. But even though we earned $2.4 million of net income, we closed the year with a cash balance of $340,000. So our cash balance only went up $27,000. How did that happen? Well, the statement of cash flows bridges that gap. So it shows us that we had sales that were recorded that are contemplated in that net income, but the cash hasn't been collected. We've also got a big distribution for tax purposes. So when you look at it, you can see it really gives you all of the puts and takes that reconcile from that income number to the ending cash in bank on the balance sheet. It's really fantastic because there's nowhere to hide. It's all right there.
Yes.
She's excited. She's so excited. I am too. Now let's get to our financial diagnostic. This is the best. We met with a local entrepreneur, the founder of some wellness facilities, about a year ago. He was quite happy with his revenue growth, but he felt like cash was tight and he couldn't figure out why. So he shared his financial statements with us, the ones we just went over: balance sheet, income statement, statement of cash flows, and we got to work. So I think we should start by reviewing the income statement, examining the profitability, and seeing if we can find any trends.
Sounds good.
All right. So we're looking at the income statement, and my gosh, the company was founded in 2019, and it looks like they have grown exponentially year over year. From 19 to 20, 200% growth, 20 to 21, 100% growth. I mean, they have grown from a $2.5 million to a $28 million company. That's pretty impressive.
It's amazing.
It's amazing, she says. Say it with more emotion.
It's amazing.
It's amazing. All right. So phenomenal. More than 10 times where they originally started. So now when we drop down and we look at their operating expenses, there aren't a lot of categories in here, maybe 6 or 7. And it looks like the biggest one that I see is payroll. Payroll, our first year was only $125,000, but our last year was $8 million. But I'm telling you, it's hard for me to make heads or tails of this because the numbers are so volatile. When we've got that 10-time growth, it's difficult to determine whether or not this all makes sense.
It is hard.
So you know what I like to do?
Yes.
I like to flip it, and I like to express the expenses as a percentage of the overall revenue. We call it a vertical income statement, and it's great because it helps strip out the volatility of the, rapid growth over a short period of time. And so now what we're looking at, we're no longer looking at the absolute value income statement. We're looking at the vertical income statement with the expenses expressed as a percentage of revenue. And this, I feel like, is telling us so much more. So in 2019, for every dollar of revenue that we generated, we kept 26.8 cents. So a 27% net margin. But by the time we got to 2023, for every dollar of revenue that we were generating, we only kept 7.5 cents. Come on.
Something's happening.
Something's happening indeed. And I see 2 things for me that leap off the page. I can see gross profit. It was 50% and it's come down to 45%. A little concerned with, I know what happened during the pandemic. We dropped a point, but then again and again, I just wonder where the bottom is there.
Keep dropping. Yeah.
Something's not adding up. And then everything outside of payroll expenses looks pretty static, I would say. It looks consistent from a trending perspective. In some cases, we're leveraging economies of scale, But looking at payroll expenses, the first year, payroll ran 5% of revenue. We know this gentleman was bootstrapped and he didn't have a big staff. But in 2020, he started to build out his infrastructure. In 2021, I think he was pretty solid. So I could see payroll expense sitting around 22, 23%, but he's at 28.
Right.
So, I mean, we see encroachment on that margin from a gross and from a net perspective. And I think it's being driven in those two particular areas. So that's really interesting. I think a couple things, but I want to hear what you think because I don't want any groupthink.
So, yes, I agree. We definitely need to dig into the structure to see what is going on in that payroll expense line. And are our costs legit in the cost of goods sold line? Are they raising? Are we not getting good terms? Or are we not charging enough on our sales?
I tend to agree. I think we need to look at pricing. I think that's got to be top of the list as far as what we cover, because there was significant volatility there. But also, if we're buying so much more from our vendors, it also feels like we should be getting more favorable terms. I suspect that there should be a group buying discount, right, which is going to help stabilize, and then also maybe better payment terms. And that payroll expense, I want to benchmark it because it doesn't feel right, but we need facts, not feelings.
How do you benchmark it?
Stop it. So we love benchmarking. Benchmarking is when we go out and pull comps for publicly traded organizations. And then we compare our results trended over a period of time against those publicly traded competitors. It's phenomenal because it gives us a frame of reference of what good, better, best performance is in a particular sector. And so even if you're a brand new organization without a significant amount of history behind you, you can still have that frame of reference. You know, I like to call trending and benchmarking good old T&B.
Yes.
Yes. All right. So we looked at the income statement, absolute value, and vertical, but I think we need to look at the balance sheet as well. All right, I've got it, the balance sheet. So I can see, not dissimilar to the income statement, we've got quite a bit of volatility here. I can see some big changes in accounts receivable from our first year to our most recent year. Our first year in operations, when we did $2.5 million of revenue, we only had accounts receivable of $170,000. But now we're doing $28 million of revenue and our accounts receivable is $5.6 million. Is that proportionate?
I'm not sure.
Oh, okay. Inventory, same story, from $100,000 to $2.3 million. And what's really confounding to me is when I drop down and I look at how they're managing it all. I mean, their line of credit, I think the gentleman told me they have a $1.5 million line of credit. They're only into it for 1.2. Just looking at this like this, it looks like there's a lot of money tied up in float.
Yes.
But I don't like looking at it like this.
Do you benchmark this too?
Of course. My gosh, it's like you're setting me up. So the same way that we were able to remove the volatility from the income statement, there's a way we can do it with the balance sheet. What we want to do is perform some metric trending. And so when we've got such significant growth, it's difficult to discern what the numbers on the absolute value balance sheet are telling us. So what we've done is we've converted some of those big numbers to metrics. The cash conversion cycle. What? Yes, the cash conversion cycle. So that's going to help us understand how much cash we're floating, but not just total dollars, how many days of float we have out there, which is really important because that's how we're going to benchmark against competitors. So do you see this? In 2019, our cash conversion cycle, we were floating roughly 17 days or about $144,000.
Mm-hmm.
And then by 2023, we're floating 81 days or
a lot of days.
A lot of days, $6.4 million. Oh, maybe we should explain the cash conversion cycle. Okay, so the cash conversion cycle is comprised of your days sales outstanding, your days inventory outstanding, and your days accounts payable outstanding. So you're selling, you're generating invoices, you're recording revenue and accounts receivable. You're waiting to get paid, right? And add into the mix that you also have inventory that has to be converted. So this is all of your dollars. How many of those dollars are held up in the cycle? And so it's a lot. The technical term here is it's a lot. Trending it this way lets us see if we've gotten out of line. mean if there's something that we've done that has been unusual for us. And then when we benchmark it, we'll again put it within those realms of reasonableness. So now looking at this, what's interesting to me is that despite our exponential growth, our vendor terms don't appear to have changed.
No. Paying around 30, 35 days since inception.
Yes. But what about our days sales outstanding?
We're not collecting like we used to.
So we used to only have 25 days sales outstanding, and now it looks like we're hovering in the low 70s.
Yes. Crazy.
Yeah. So I like it when my days sales outstanding and my days payables outstanding are close to the same.
Imagine that.
Yes. All right. And then the days inventory outstanding, it looks like we ran pretty consistently there, 30. We crept up a little bit, which I get during COVID. There were supply chain issues. We might have felt like we needed to stockpile. But from 2022 to 2023, we increased 20%.
Yeah. So, what are we buying? What are we holding on to?
I mean, why? So many questions. All right. So that's the cash conversion cycle. But now let's look at the liquidity of the business. So let's look at the current ratio. How many times can the current assets, the cash, the accounts receivable, the inventory cover our current liabilities? 5 times. That looks pretty good.
It's pretty good, yeah.
Also might indicate some inefficiencies, but it looks pretty good. The quick ratio, when we look at that, also pretty steady and stable. The quick ratio is the current ratio, excluding inventory. So we're looking at the more liquid assets, taking out the most illiquid. We're sitting at 3.5. But the cash ratio, we were at 2, and now we're down to 0.42. Not great. Gone down pretty significantly. All right. I feel like the riddle is very easily solved here. How many days of cash do we have on hand? Days cash on hand.
25 days.
Okay. So what this means is if we didn't receive another dollar in payments, we would be able to continue to operate the business for 25 days, right?
It's less than a month.
Well, and we used to have 170 days and then 52 and now 25. It feels a little light and like there's opportunity for some definitely improvement, but there's opportunity for disruption if there's one thing that happens that we're not prepared for. The debt ratio is good though. Like it's nice and low. Debt to equity has been well managed. There are definitely some things that we can do here, but we need to get to work.
Yes.
Oh my gosh, is it time to benchmark?
Benchmark. You keep talking about it. I want to see it.
Yes. My gosh, can't wait. Okay. So benchmarking. So like we talked about, we went out to the SEC, we pulled some publicly traded competitors' information, and we've expressed that information as a percentage of overall revenue, which is really magical because it allows us to compare our $28 million business to a $1 billion business or a multi-billion dollar business because we're just looking at pennies. All right. So I see ARCO and then comp 1 and comp 2. And when I look at this, cost of goods sold.
Yeah, ours is really high.
Yeah, so our cost of goods sold has consistently increased. It's grown 10% over the last few years. And when I look at comp 1, I can see that it's grown a little bit, popped up during the pandemic, and then it's held steady. Comp 2 popped up significantly during the pandemic, and they've held steady. Looking at the two comps, it looks like to me we should be running between 48 and maybe 51% gross profit, and we're running 45. So that's a notable amount of points that we could pick up, and there are probably a couple of different ways that we could get there. Vendor discounts, increased pricing, a couple of ways. Operating expenses. All right, so we know operating expenses is largely comprised of the payroll expense, the behind-the-scenes support. And oh my gosh, we're running close to 37%. But these comps are running, what is that, 28, 29%?
Yeah, right around 29.
And we're running 36, 37.
Big difference.
Yeah. So it looks like when we built out our cost structure in 2020, it was conducive to the revenue that we were generating. But it looks like we might have gotten a little over our skis from 2020 to 2021. I wonder if it's one of those cases where we know, like, your son's going to wear a size 9 shoe but he only wears a size 6 today. But we went ahead and got the size 9 anyway, hoping he'll grow into it. But it doesn't look like his feet have grown as quickly as we expected. So I suspect that there's an opportunity there to right size. So looking at this, to me, that pretty clearly explains why we've dropped from the 27 to the 7.5%. But it also reinforces that other folks are not.
Yeah, we can do better.
We can do a lot better. I mean, we could do between 19 and maybe even 23%, which would be absolutely fantastic. So that was the income statement, which again, everyone's super excited about. We get it. Talk nerdy to us. That's why we're here. But this gentleman came to us concerned about the cash, right? Palpitations, tightness in his chest. So what's happening there? Oh my goodness, do you see this? When we look at Comp 1 is only floating about 18 days of cash. Comp 2 is floating about 29. And when we look at the little inputs that comprise that overall cycle, I can see Comp 1 has done a really great job of managing their days sales outstanding harmoniously with their days payables outstanding. And it looks like Comp 2 is close, but Comp 1 is doing a phenomenal job. So they're floating the least number of days, the least number of cash. All right. But there's definitely a bit of divergence in performance. And look at the inventory. What are your thoughts there?
So it looks like for Comp 1 during the pandemic, they did pop up. So maybe they were worried about that supply chain and they stocked up. A little pop-up in 2021. That's also a residual of probably the pandemic. But starting in 2022 and 2023, they're starting to bring it down, almost close to pre-pandemic. Comp 2, it looks like maybe they didn't stock up during the pandemic. Maybe they did run into those supply issues, but they are also coming down in 2023 back to pre-pandemic.
I feel like we can do better. I feel like we can do better. It looks to me like we don't need to float nearly as much as what we're currently floating. There's an opportunity, maybe some checks and balances, some internal controls around the inventory, something around the day sales outstanding. I mean, I feel like the opportunities abound. And then when we drop down and we look at the days cash on hand, Comp 1 has a lot of cash. Comp 2, they're running pretty thin. I mean, that would make me nervous. That's a broad upper and lower bound. I would be a little bit more comfortable if we were maybe sitting closer to like 35 to 50. Right now, it is screaming at us that there are inefficiencies that need to be addressed. I mean, overall, when we look at the current, the quick, the cash, all of that, like together, this says that we have strong liquidity and conservative debt usage. But in reality, that long conversion cycle is presenting some pretty significant challenges for us, and there's a way to fix it. Comp 1, they've got great liquidity and moderate leverage. It's that tight conversion cycle that's supporting that. Comp 2 scares me. I understand that people might just be looking at their P&L and super excited about that strong margin, but that low cash reserve and that tight conversion cycle, that high leverage, they've got such financial risk, but efficient asset conversion.
Yes.
They need some help.
Yes.
All right. So, I mean, takeaway after looking at that, and apologies because I've broken a sweat. I applied deodorant twice this morning, so I can only imagine how you're feeling. But looking at that, I feel like profit margin improvement, no doubt. Review the pricing strategies like we talked about. Negotiate better terms with suppliers.
Get that discount.
How much do you want?
Yeah, right.
How much do you want? Especially if we have preferred vendors, right? We're
Right.
guaranteeing that business. And then also identifying and remediating the operational inefficiencies. So we likely need to really right-size that infrastructure and make sure that we're embracing technology appropriately.
Technology?
Yes, OCR, optical character recognition. We don't want teams of data entry people, right? We want everyone to operate at the top of their license. But this gentleman came to us because of cash flow. So we can address the other items next. But from a cash management perspective, I mean, are you dying to put in a 13-week or a 26-week rolling cash forecast?
That's number one. Number one thing we got to do is look at that cash forecast.
She's been itching to get to it. I wish you could see her twitching over here. What else could we do? We could definitely optimize the conversion cycle.
The inventory management. Like, what is in there? Why do we have so much?
Fidget spinners. I mean, I don't know. We need to improve that. Checks and balances, internal controls. And then as far as payments from our customers, we need more stringent credit controls.
Yes. How many days do they have? And is anybody following up those that haven't paid?
If we want to give 70 days to pay, we need 70 days in return.
Yes.
All right. And then insufficient working capital to fund expansion. And at the end of the day, this gentleman is highly entrepreneurial. We know that he wants to continue to grow and do more to perpetuate his mission, but he's likely going to, number one, have to right size that conversion cycle so we don't have all that liquidity tied up there. We can invest it in growth. But also, sometimes it's tough to fund expansion through existing operations. So I think procuring an appropriate financing option would be key.
Yeah, the one he has needs to be looked at.
Yes, it might be a little underserved, as it were. Stop it. Not underserved. Yes. All right. Well, I mean, that was a lot, but I feel like this financial diagnostic provided us with a very clear picture of what was happening and highlighted areas for improvement. So it's like we've turned on the lights and we can see all the ants on the counter, which I know is gross, but it's also great because knowing what the issues are is half the battle. And I am not quoting
G.I. Joe.
G.I. Joe. Because now that we know, we can develop that order of magnitude and begin addressing the issues one by one. And as we do, the company's going to strengthen its financial position, allowing it to support sustainable growth. Are you excited?
I'm excited. In our next episode, we'll focus on one of these key areas, cash flow management.
Stop.
We'll dive deeper into strategies for identifying, managing cash flow issues. Following that, we'll bring in a treasury partner. What? A partner?
A partner!
Okay, we'll talk about what qualities to look for in a financial partner and the solutions they can offer.
I'm really excited. It's a special guest. We'll tell you later. Thank you for tuning in to Talk Nerdy to Me. Don't forget to subscribe, share, and leave us feedback. If you have any questions or topics you'd like us to cover, reach out to us at thewilliamstanleycfogroup.com. Stay tuned for our next episode where we'll dive into cash flow management. Until then, keep nerding out. Okay? Bye.
Bye.